Well, hello everyone and welcome to the webinar. My name is John Bowens with Equity Trust Company. In today's program, we're going to be covering the frequently asked questions in the self-directed IRA industry. The inspiration for today's program really came out of all the questions that we've accumulated over the years, and we find patterns of questions coming up. And what we'd like to do in this program is talk about those common questions and hopefully demystify some of those uncertainties and some of the unknowns that are in the self-directed IRA business that are most common to individuals that are looking into this for the first time, or even folks that have been doing this for a number of years, and there could be other possibilities or other opportunities that they may not have thought of before in the past. So really excited about today's program. Again, my name is John Bowens with Equity Trust Company. For those of you who aren't familiar with Equity Trust Company, we are a passive self-directed IRA custodian, and our core competency, if you will, is helping investors invest in alternative assets. Now, when I say helping, I don't necessarily mean facilitating finding deals, finding opportunities, but rather facilitating the custody work involved with holding an alternative asset, that being real estate or notes or private equity, small business startup investment opportunities, venture capital, hedge funds, precious metals, cryptocurrencies, and a variety of other alternative assets that we'll explore a little bit more in depth as we progress throughout the presentation. Now, before I get into the actual Q&A portion, I do need to make sure that I have everyone on the audience with me in terms of what we do and what we don't do. So here at Equity Trust Company, we provide a lot of education, a lot of information, a lot of knowledge sharing. We provide case studies of clients that have done this before in the past, that are fixing and reselling property, individuals that are holding rental properties in their IRA, they're making loans with their IRA, they're doing all of these unique types of investments. We can share those stories. But in no way, shape, or form are we providing tax, legal, or financial advice. We're not here to be your attorney or your CPA. In fact, we would encourage you to do your own due diligence prior to engaging in any transaction, whether it's in the traditional stock market or it's in the non-traditional investment realm. And you'd want to make sure you build your financial team. We're just one member of your financial team, if you will. And of course, if you're engaging in investing with a third-party investment sponsor, real estate investor, private equity investment sponsor, whatever the case may be, it's important you perform due diligence on the character of that individual and the suitability of the investment for your own portfolio. Again, Equity Trust is here to serve as the passive custodian for your IRA, 401k rollover, or other self-directed account. And we'll get into that a little bit more in depth in just a moment. So the first question we have for our audience today is very basic 101 to start. What is a self-directed IRA? And you're probably thinking to yourself, or for those of you that have a little bit of experience, you're thinking to yourself, well, that's pretty straightforward. That's what you guys do, right? Is self-directed IRAs. Well, we actually do a lot more than that. And there are other self-directed accounts, not just IRAs, that you can take advantage of. And I'll talk about that in just a second. But the common hurdle for a lot of newer folks is, well, what's the difference between an IRA with my current financial institution and the IRA that you offer at Equity Trust? And really, the IRA in of itself is the same. The IRA that we offer is no different than an IRA that would be offered at any other company, so to speak, any other financial institution. The difference is the infrastructure, the technology, the personnel, and what we allow you to invest in here at Equity Trust Company. And when I say allow, I don't mean that we're looking at a transaction from a legal perspective, but rather what I mean is we will custody more unique alternative assets, whereas most other IRA institutions, financial institutions, will only allow you to hold stocks, bonds, and mutual funds. So it's not a matter of legality, but rather a matter of choice. In fact, if you go to the IRS website, irs.gov, and you search real estate IRA FAQ, you're going to see it states in black and white, and I'm paraphrasing a little bit here, but it states in black and white that real estate is a permissible investment in an IRA. But due to the administrative burden, financial institutions aren't required to hold real estate in your IRA. So again, it's not a matter of legality, but rather a matter of choice. Self-directed is merely an industry term indicating to you that you are in complete control. You have the ability to determine where you want to invest and how you want to invest. And so as long as it's within the confines of the Internal Revenue Code and the IRS guidelines, then equity trust for the most part can custody that asset in your retirement plan. Now there are 7 different account types that you could take advantage of. The first account type and most common in terms of the questions we get is a traditional IRA, tax-deductible IRA. So if you have an old 401k rollover, 403b, or thrift savings plan, generally speaking, so as long as you do things properly, you can roll that money over into a traditional IRA, into a tax-deductible IRA. And when I say tax-deductible, I'm talking about an IRA that when you put money in, you get a tax deduction for, you grow it tax-deferred, and then when you take it out, you pay taxes. Now there's also the Roth IRA. The Roth IRA, in contrast to the traditional IRA, you put money in after tax, it grows tax-free, and when you take the money out after 59.5, assuming the account is seasoned for 5 years, it's tax-free. So the Roth IRA and the traditional IRA can have very unique tax advantages. The Roth IRA in particular, not that one is better than the other, but the Roth IRA in particular allows you to achieve tax-free profits going in and then tax-free withdrawals after the age of 59.5. Again, you're just not getting a tax deduction on the contributions that you're making, whereas with the traditional IRA, you would. So those are IRAs, traditional IRAs and Roth IRAs. There are then 3 small business retirement plans that we see folks taking advantage of: a simple IRA, SEP IRA, and solo 401k. Again, that's simple IRA, SEP IRA, and solo 401k. And then last but not least, there are 2 other account types that aren't IRAs, but they are self-directed accounts and have unique tax advantages. And that is the Coverdell Education Savings Account. So for children or grandchildren that you want to set them up for success for their K through 12 or secondary education, you can set up one of these account types. You can invest in real estate, in stocks and mutual funds and other alternative assets. And then all of the profits that you take out, assuming that you're using it for educational expenses, are tax-free. And then the health savings account. So for those that have a high deductible healthcare plan, you qualify for an HSA, you can make contributions, potentially get tax deductions, grow it tax-free, take it out and use it for healthcare related expenses in a tax-free fashion all along the way, using that HSA in our realm to invest in alternative assets primarily. So there are different account types that can be utilized going forward, and we'll talk a little bit later about how one could potentially look at partnering multiple IRAs in order to make investments. So in terms of investments, now that you know a little bit about the IRA framework, let's talk about what are the common examples or common investments held in a self-directed account. So one of our core focuses here is real estate, so holding real estate in an IRA. And really, in terms of looking at investments, I bucket these investments into 3 categories. The first is real estate. The second would be note investing, so holding paper, if you will, in your IRA. And then the third would be private equity or private business investment opportunities. So in the real estate realm, we find folks buying, fixing, and selling properties in their IRA. We find folks buying properties and holding them for longer-term cash flow. We find folks wholesaling properties or doing real estate options. There's a variety of different ways in which you can invest or participate in investing in real estate with your IRA. So to give you the most common example of buying property, let's say, for instance, an investor purchased a property for $50,000. Let's say they put $10,000 worth of work into it and they rent it out for $900 a month. Their IRA would buy the property. The IRA would pay cash for that property purchase. In most instances, that's how we see it done. IRA buys it in cash. The IRA is taking title to the property. The IRA pays for the $10,000 in fix-up and repairs. Now the investor's in it for $60,000, and now $900 is coming back into the IRA every month. So those checks or direct deposits are just going directly back into the IRA, and they're going tax-free or tax-deferred, depending on whether it's a traditional or Roth IRA. So that's just one example, hypothetical example. Now moving on to notes. So investors could also look at buying existing residential mortgages or buying existing notes. And then also we find investors make loans. Some people refer to themselves as private lenders using their IRA money. Others refer to themselves as hard money lenders. And there's somewhat of a difference between hard money lending and private lending, and that would be for a different program. But relatively speaking, one could look at using their IRA and making loans to other investors to buy, fix, and sell properties, so rehab properties. Or maybe it's going to be a longer term loan where someone's going to loan money from their IRA to an investor to hold a rental property, and they're going to be paying them principal and interest payments. In other words, and in summary, it is your IRA essentially being the bank, your IRA holding a promissory note. And in most cases, we see a promissory note secured by a first lien or second lien or third lien mortgage or deed of trust, depending on the state in which the property is held in. So that is simply the IRA holding a promissory note and mortgage. The IRA is a lender. And then last but not least, private equity. So investing in non-publicly traded investments or non-public investments. That doesn't mean you can't use your IRA here at Equity Trust to invest in traditional stocks and mutual funds and things of that nature, more traditional type investments. We do have platforms to accommodate investors to invest in stocks. They can self-direct their own trades as well as self-direct mutual funds. And in terms of conducting those types of activities, Equity Trust is a non-advisory custodian, so we're not here to facilitate where to buy and how to buy and things of that nature. One would work through the necessary channels and work through ETC brokerage in order to make those particular types of trades all on their own, and much of this can be done online. Going back to private investments, so Regulation D 506 offerings, private equity investment opportunities, investing in hedge funds. If someone has an opportunity to invest in an LLC, and that LLC, let's say their objective is to pool money and go out and invest in apartment buildings or residential single-family homes, then one could use their IRA and become a member of that LLC. There are rules and there are guidelines that have to be followed when investing in small businesses or investing in startups. So you do want to make sure you work with your CPA or attorney potentially. But that's another category, if you will, of alternative assets. So those are the three categories. There is one other category that I want to mention, and this is sort of an ancillary fourth category, and that is, and I mentioned at the very beginning, cryptocurrencies. We refer to this as digital currency investing, and Equity Trust just recently, in fact, unveiled a digital currency platform, which enables investors to self-direct their IRA money into cryptocurrencies. And there are 6 coins that the platform supports. So one would open their account with Equity Trust, enroll in the platform, and then from there they have the ability to purchase Bitcoin, Bitcoin Cash, Ethereum, Ethereum Classic, Ripple, and Litecoin. And we have an entire webinar and series, if you will, on the digital currency platform and investing with your IRA in digital currency. We don't per se advocate whether it's a good or bad decision to invest in cryptocurrencies at any one given time. We're just merely providing that platform for our investors to choose to take advantage of that if they determine it's suitable for their portfolio. So a lot of different things you can do with the self-directed IRA from an investment perspective in summary. So who are disqualified persons to the IRA? So I mentioned some things you can do with your IRA. In fact, a lot of different options in terms of what you can do with your IRA. Let's talk about some things you can't do with your IRA. So the first thing to understand is that you cannot transact business with disqualified persons. So I'll repeat that. You cannot transact business with disqualified persons. Now, who are disqualified persons? Let me define that for you. Disqualified persons include the account holder to you, your spouse, any lineal descendants, children or grandchildren, any lineal ascendants, parents or grandparents, and then any entity such as an LLC or trust or joint venture that is owned 50% or greater by the aforementioned disqualified persons. For additional information, I would encourage folks to visit publication 590 You can go to the IRS website, irs.gov, for this information, or you can go directly to the Internal Revenue Code as well, which will detail out who disqualified persons are and what the transactions are that would deem a prohibited transaction. And that would be Internal Revenue Code 4975. Again, I'll repeat that. That's Internal Revenue Code 4975. And as always, I'd encourage you, if you're going to engage in some more unique transactions, to work with a competent either tax professional, CPA, or maybe even a tax attorney that can understand and interpret the tax code per your specific situation. Having all that being said, in most scenarios that we come across as investors are buying and selling real estate, they're not transacting business with disqualified persons, and therefore there are no issues in terms of them using their IRA to invest in the opportunities that they're taking advantage of. So going back to who are disqualified persons again, those are as follows. And now we need to lead into our next question, which is, what is a prohibited transaction? So if you engage in a transaction with a disqualified person, then you trigger what they call a prohibited transaction. And a prohibited transaction, the consequences, which is the next question, is your IRA would cease to exist January 1 in the year in which that transaction occurred. So let's say, for instance, we're in the year 2018 at the time of this recording. Let's say an investor engaged in a prohibited transaction back in 2015, and it was determined in this year through an audit or through some other type of situation that it was a prohibited transaction. That account would be considered distributed January 1 in the year 2015. So that entire IRA can be distributed, which means there would be tax consequences in most scenarios. If they're under 59.5, there would likely be a 10% penalty, and then there could be a 20% accuracy-related penalty. And obviously, attorneys' fees and court costs and things of that nature would have to be applied. So one would certainly want to make sure they're looking at transactions objectively. They're not engaging in prohibited transactions, so they don't put themselves in a situation where they have adverse tax consequences. So let's give some examples of a prohibited transaction. So the first thing, as I mentioned, is disqualified persons. Disqualified persons who are transacting business with an IRA trigger a prohibited transaction. So let me give you a couple examples to apply this. Let's say an investor, and these are the common questions, by the way, we get when folks call us up on a daily basis. Let's say an investor approaches us and says, I own a property personally or in my LLC's name, and I want to put it in my IRA. That would be a prohibited transaction because the account owner or their LLC that they own is a disqualified person to their IRA. So if their IRA bought the property, even at fair market value, that would be a prohibited transaction. It's considered a transaction. Under 4975C1A, the purchasing or leasing or sale, etc., of an asset between a planned and disqualified person is a prohibited transaction. So that would be prohibited. The second most common prohibited transaction question we get is an investor is looking to buy a rental property, like a vacation rental, a VRBO or Airbnb, or one of the other sort of vacation type rental investment strategies, and they want to stay there a couple days out of the year. That would also be considered a prohibited transaction. So you can't use an asset for your own personal benefit. That would be considered a prohibited transaction. And then last but not least, we find investors will attempt to borrow money from their IRA. So they have an LLC. In many cases, it's an investor who has an LLC and they're looking to buy, fix, and sell properties, or they're looking to maybe buy rental properties, or they're conducting real estate activities, and they want to use their IRA essentially to fund that operation. And so their thought is, oh, I'll just take money from my IRA and make a loan to my LLC. That would also be a prohibited transaction. Under 4975C1B, the lending of money or extension of credit between a plan and a disqualified person is a prohibited transaction. So you got to be careful with that. The idea is one would need to look at this objectively and say, how can I use my IRA to buy a new property, put whatever money into it as necessary, and then have all the money go back into the IRA from the profit? Or make a loan to a third party who's not considered a disqualified person, possibly secured or unsecured, but in many cases we see it secured by the real estate. So we mentioned if engaging in a prohibited transaction, what the implications were. This leads us to, can I do the physical work on an IRA-owned property? So this could be considered a prohibited transaction. Under 4975C1C, the furnishing of goods, services, and facilities between the plan and a disqualified person. So the rule of thumb that's used if you own rental properties in your IRA or you're going to fix and flip a property is you cannot perform the sweat equity. Rule of thumb is you can do the desk work, but not the sweat equity on those IRA-owned properties. If not considered a service and therefore a prohibited transaction, there are arguments that if the work done at commercially reasonable terms and rates could be considered more than the contribution limit for one given year, then you would be making an excess contribution to the IRA, which would also incur penalties. So you want to, again, at the end of the day, stay away from doing the physical work. You can't be swinging the hammer to the nail, so to speak, on your IRA-owned properties. And that dovetails into, can I pay my own property management company or construction company to perform services on my IRA-owned properties? And the answer is you cannot, because going back to our prohibited transaction discussion, that can be construed as disqualified persons transacting business with the IRA, therefore a prohibited transaction. There is a case on this, the Neiman case, N-I-E-M-A-N-N. And this started off as a situation where the investor was flipping houses using their self-directed IRA money, which was okay, but unfortunately he was paying his construction company for the services rendered in rehabbing those properties, renovating those properties, and there was the prohibited transaction. His construction company that was owned by himself personally, that construction company was a disqualified person and was receiving cash payments from the IRA to perform the services to renovate the property, and it ended up being a prohibited transaction. So you want to stay away from paying any companies that you own or even affiliated with for managing properties or performing renovations, et cetera, et cetera. Is it possible to partner multiple self-directed accounts to make an investment? So this question's placed in here perfectly for us because I was just talking about disqualified persons and transacting business with one another. And there's this concept of partnering multiple IRAs together or multiple disqualified persons partnering with one another. And what I can say is in terms of partnering with disqualified persons, it's not deemed unacceptable under the Internal Revenue Code. But I'm not going to say that it's permissible and that you don't need to proceed with caution. You absolutely need to proceed with caution when you're partnering your IRA with other disqualified persons. That being said, I have seen it done multiple times, and I have seen it done successfully on multiple occasions. So what this concept is, and I'll give you a couple examples in real use cases. Before I do that, I'm going to show you this graphic. We had an opportunity to display this to folks all across the country, and we found that it really helps them paint the picture for what the possibilities are with their self-directed experience through equity trust. So for some investors, it's just investing with a traditional IRA or a Roth IRA. For some people, it's a traditional and a Roth. For some people, they take advantage of all of the potential tax advantage dollars. And they have HSAs and covered education savings accounts for their children or grandchildren. Some establish, in addition to that, a solo 401k with a Roth component. And the idea is they're taking advantage of the maximum contributions they can make to these accounts on an annual basis, therefore giving them more tax advantage dollars that they can go out and invest with. And those tax advantage dollars create more tax advantage dollars, which create more tax advantage dollars. And they're leveraging compounding interest in the absence of taxation. So as we go throughout the rest of the call, for those of you that are currently self-directing and you didn't know that, hey, I could self-direct these other account types and, hey, I have the ability to make contributions or transfer rollover money, you can start considering how do you build to take advantage of more opportunities. So going back to our partnering with multiple accounts, let me give you a couple use cases. So our named investor in 2017 as the Investor of the Year, Brian, He did 2 transactions in 2017, which yielded his IRAs and investment accounts for his family over $130,000 tax-free. So on the first deal, Brian found a vacant lot, and his all-in cost was about $8,000. So he bought a vacant lot for $8,000 using his 3 children's covered education savings accounts. And CISA 1 put up $4,000 of the $8,000 purchase price. And the other 2 CISA accounts, covered education savings accounts, put up $2,000 each. So the proportionate split was 50% CISA 1, 25% CISA 2, and 25% CISA 3. They bought the property for $8,000. He sold it for around $60,000, about 60-day close. So in under 90 days, the 3 CISA accounts made about $52,000 in net tax-free profit. 50% of that $52,000, so about $25,000 and some change, went back to CISA account 1, and then the remaining amounts went to the 2 other CISA accounts. So again, it was 50, 25, 25. So you got to make sure that everything is done proportionally when partnering with disqualified persons. Another scenario, a client bought a property for, it was around $80,000, and they partnered. 75% of the property was owned by their IRA and 25% was owned by them personally or owned in their LLC. So they bought the property, they put the down payment down, 75-25. They put work into the house, 75-25 all along the way. And then when the profits came back in, 75% went back to their IRA Roth tax-free, and the other 25% went back to them personally. So that's another idea. It's a little different because it's not 2 IRAs. It's actually someone's IRA and their non-IRA money. Last but not least, going back to Brian, I mentioned before with the 3 CISA accounts, what's interesting is on the second deal he did in 2017, to be able to achieve that full $130,000, what Brian did is he partnered on a deal with 5 of his family members' accounts. He had 3 of his children's CISA accounts, and then his Roth IRA and his wife's Roth IRA. So they all partnered together. They bought a lot for $120,000 in about the same area where they bought the previous lot, and they sold it to a developer who subdivided the lot into 2 lots and built townhomes on the property. And the sale price was around $200,000. So he actually made about $80,000 in net profit. And that $80,000 was split between his Roth, his wife's Roth, and then the 3 children's covered education savings accounts, proportionate with the original ownership interest. So you can carve up these transactions really in any way that you see fit. The idea is develop your plan in terms of what is your orbit or constellation going to look like. Get money into those various IRAs or investment accounts, get them prepped and ready to go. And then when you find an investment opportunity, you can pull the trigger and you could grab money from the respective accounts that have available capital, and then you can put those into those transactions. And then, of course, as always, map this out on a pad of paper or a PowerPoint slide deck, and then give it to your attorney or your CPA and have them help you paper the transaction. That's the key. Equity Trust isn't here to paper the transaction for you, but you would get these ideas and then you would give those to an attorney or CPA so that they can look at those objectively and determine how to actually paper the transaction. So you could be thinking about, hey, here are all these account type possibilities, and oh, okay, now I can go out and find investment opportunities and partner on multiple deals. So that leads us to, what is the process to actually buy real estate? Well, there's different ways that you can do this. I am going to speak to, on this particular question and slide, on the Equity Trust technology solution. Now, for those of you that have been with us for a number of years or have been around the self-directed custodial business for a number of years, you'll know that for many years the process was quite daunting. It was a lot of paperwork and faxing and scanning and emailing and kind of going through this what some would consider a burdensome process. Equity Trust Company, with those thoughts in mind and processing thousands, hundreds of thousands of real estate transactions, we recently were able to build out a technology stack, technology platform that really meets a lot of our customers' needs. So let me walk you through what this system looks like. Now, we call this system My Equity. My Equity is the online access for our clients to manage their account, to execute real estate purchases seamlessly, to process bill payments on their IRA-owned properties via direct deposit or check, and ultimately giving them the peace of mind knowing that their transactions are going to be processed in a seamless and efficient manner, and ultimately giving them more time back in their day so they can focus on the investment. They're not focusing on all the time, where's my money at in transit? I need to check in on this. I need to make a phone call. I need to send an email. Allow us to do a lot of that heavy lifting for the individual client, all while still in that self-directed environment. So it's simply a three-step process when buying real estate with your IRA, and I'll give you a hypothetical here. So step one is you're going to execute on an offer. Step two is you're going to execute on the closing of the property. And then step three is you're going to manage the investment. All right, so three-step process, and you can follow along with me here and write this down as I go along. So the first step of the process, of course, is to make an offer. And let's use the hypothetical example of buying a property for $50,000, putting $10,000 worth of work into it, so in it for $60,000. And then let's say they're going to rent it out for, we'll call it $900 a month. So $60,000 all in, $900 a month coming back into the IRA. So step one is making the offer on the property. In this instance, the purchase contract is going to be in the name of the IRA. So it's not in the name of an LLC or in the name of any other type of trust or the individual personally. It's in the name of their IRA. And the formatting for that is equity, trust, company, custodian, FBOs, and for benefit of, the client's name or account number IRA. So they provide that titling on the contract. And then when they need an earnest money deposit, let's say in this instance, the client needs a $1,000 earnest money deposit for the $50,000 property. So they're going to go online through their My Equity account, and this is something that can be done in just minutes with a smartphone or tablet or on one's PC. They're going to place an order for that $1,000 earnest money deposit. So there's going to be a series of screens that are going to ask questions about the property itself, giving us the details, approximate closing date, and all of the pertinent details that the client has at that time. Now, we understand you may not have all the details at the very beginning, but you have most of the details in order to start the process. So you can do this within minutes, again, on your smartphone, mobile device, or PC laptop. You go through the process, and then you hit submit, and within 24 to 48 hours, we have a wire transfer sent out to the escrow account, or if we're sending a check, within 24 to 48 hours, you have a check being sent out. And there are options to expedite. There are options to send those funds directly, again, via a wire transfer, so that you're not waiting multiple days to get a check. So the idea is to be able to secure the properties that you're looking to acquire in the shortest period of time. So now that you have the property under contract, you're ready to go to the closing. So at that time, you're going to have an investment liaison that's assigned to the transaction. Again, much of this is automated online. They're going to help you through the process. You can provide the authorization to Equity Trust Company to work directly with your title company. So we're reaching out to the title company, we're helping and coordinating the closing, and we're getting any and all sign-offs from you directly. So we always, through the process, make sure we get your authorization before we do anything. So you complete the process. Everything can be docu-signed online, document uploaded, or the title company sends us the documents directly for us to sign and send back, and then we wire transfer the money. So now the deal's closed. The $50,000 property is in the IRA. And so you have a deed in the IRA where your IRA has title to that property instead of the $50,000 in cash. So it's no different than buying a stock or mutual fund. When you buy a stock, cash leaves the account. In return for the cash is a stock certificate. When buying properties, cash leaves the account. In return for that cash is a deed to the property. Now, using our example, we have $10,000 worth of repairs, and you have taxes, insurance, and various expenses that come up. And so the investor can use our online bill pay functionality. And this is a very, very powerful tool for investors to be able to utilize. From their smartphone, mobile device, PC, they can simply log online and say, Equity Trust, I need you to send a direct deposit or a check to XYZ Contracting Company. Please mail it to this address, or if it's a direct deposit, we're sending that money out. So you can imagine an investor who's working with a contractor they're sitting alongside of them on their mobile device, and they say, okay, can I have your bank account number and routing number? I'll send you a direct deposit. And so now the investor is able to almost instantaneously process a transaction, provide confirmation of that, and within a short period of time, that contractor or that utility company or that vendor is receiving their payment. Of course, we can process a check as well, which we've been doing for a number of years. So you can simply go online and have checks mailed directly to you, made payable to the recipients, and then you can hand deliver them, or we can mail them directly to the recipients. So that online bill pay feature is a very powerful tool, and a tool that we've gotten a lot of great feedback about here at Equity Trust. So now you got the $10,000 worth of repairs in the house, and you're ready to rent the property. You place a tenant in the property, and you're getting $900 a month. So that tenant is going to make the check payable to your Equity Trust IRA and mail it to us for deposit, or maybe mail it to you first, and then you forward it to Equity Trust Company. Either way, the check is made payable to the IRA. And then we deposit that, and you can log online and track the progress and make sure it's being deposited accordingly. If your tenant would prefer to send a direct deposit, you can also provide them the ACH information to send a direct deposit into the IRA on a monthly basis. So fully ACH capable, as streamlined and as efficient as we possibly can provide a system to our clients. Moving on, can I get a conventional loan to buy properties using an IRA? So what I've mentioned before or up until now is primarily cash buying transactions or cash bought transactions with the IRA and or partnering with multiple IRAs. There is the option for the IRA to borrow money. It's less common than the cash purchase transaction or partnering multiple IRAs, but it can certainly be done. When borrowing money using your IRA, you have to get a non-recourse loan. You cannot use a conventional lender. The reason why is because most conventional lenders are going to require a personal guarantee. And under 4975C1B of the tax code, it would be considered a prohibited transaction if you personally guarantee debt that your IRA took on. There are what they call non-recourse lenders. Non-recourse lenders are lending with the understanding that in the event of a default, the only recourse is against the subject property, and they are not requesting a personal guarantee from the IRA account owner borrower. So this list of non-recourse lenders, you could do research and maybe search non-recourse lenders, and most likely you'd find a population of banks, and you could reach out to them in inquiry. We don't necessarily or per se provide recommendations for non-recourse lenders. I've heard of some folks also working with private lenders. In addition to that, I also have heard of individuals finding private investors who have money or financing, and they will buy a property through some sort of joint venture with an investor. The one thing to be aware of when your IRA borrows money to buy properties, to fix up and rent or fix up and sell, is the IRA can be subject to a special tax called unrelated debt financed income tax. And it's a special tax on IRAs when they buy properties with debt financing. And essentially it's a tax on the profits applicable to the debt finance percentage of the property. So if you bought a property for $100,000 and got a $50,000 loan and you're at, let's say, 50% debt financed, then 50% of your net profits would be subject to this unrelated debt financed income tax, which would be applied to the estate and trust tax schedule. So you can do a little bit more research on this. We also have additional educational materials. Again, we don't provide advice as to whether you should or shouldn't borrow money when buying properties with your IRA. You ultimately want to make your own determination and do a pro forma analysis as to whether it's a good idea or not. I can say that there are folks out there that do it, and they do pay some tax, but they look at that tax and bake that into their return on investment, and if they feel their return on investment is still suitable for their portfolio, then they would proceed with the transaction. So, moving on, can I use a land trust, title holding trust, or personal property trust to purchase properties with the IRA? The answer is yes. It has to be done in the proper manner. The idea here is an entity is formed, such as a land trust or title holding trust or personal property trust. The IRA becomes the 100% beneficiary of that trust, and then you have a third-party trustee, and that third-party trustee is critical. That third-party trustee cannot be you, cannot be your LLC, cannot be any other disqualified person. And then what we see investors have done is they have a bank account in the name of that trust. The IRA money is sent to that bank account, and then when they buy a property and they're renovating it or renting it out, all of the income and all the expenses is flowing out of that bank account. You want to be careful when you do these types of things because you still can't commingle funds. You have to be careful with self-dealing transactions. You're essentially taking the cash and taking all of the controls away from the equity trust system, and now you're delegating those to yourself personally or the trustee of your trust. But again, that is an option for investors. We would just let people know to work with their attorney, set up the entity, and then go through our standard procedure here at Equity Trust to facilitate that transaction. Do I have to establish an LLC to have a self-directed IRA? That's another great question. This sort of goes along the lines of this question about land trusts and title holding trusts, etc. The answer to the question, you do not. You are not required to establish an LLC to buy properties with your Equity Trust IRA. When I gave you that three-step process, in nowhere did I mention any LLC. Now, if one felt strongly or was advised by their attorney to have an LLC in conjunction with their IRA to buy properties, the way that our procedures are here at Equity Trust, for a very good reason, is you set up the LLC, your IRA becomes the 100% owner of that LLC, or maybe there's multiple members, so the IRA is a member of the LLC, and then you must have a third-party, non-disqualified person serving as the manager of that IRA-owned LLC. And the reason for that is because, this is not a legal opinion, but the reason for that is because there could be the possibility that if you are the account owner of your IRA and you are the manager of that IRA-owned LLC, that you could violate the Internal Revenue Code and engage unknowingly in a prohibited transaction. 4975C1C, the furnishing of goods, services, and facilities. That could be construed as a service. So it's important that you have a third-party manager serving in that capacity. Again, that's not a legal opinion. IRA-owned LLCs that are managed by account owners are not considered disqualified transactions or impermissible entity structures, but we know that there could be a day where that would occur. And so Equity Trust in our procedures, we require that the client appoints that third-party manager to serve in that capacity who can't be a disqualified person. So that leads us to, as we talk about the LLC formation, I wanted to reiterate the My Equity bill pay system because I found that investors, the reason why they are so keen on having an LLC or a checkbook LLC IRA is so that they can quickly write checks. And so in knowing that, Equity Trust Company wanted to provide a solution that would accommodate investors that need fast access to cash to be able to pay for bills and contractor payments and things of that nature, but do it in a controlled manner and do it in a manner that allows you to have a system of record within the Equity Trust system. So you're not managing your own records in your own LLC account. It's all being managed through the Equity Trust online bill pay system. And so again, to reiterate, you're simply going online and saying, Equity Trust, please make a check payable to XYZ Contracting Company, mail it to this address. You hit submit, and then we're processing that transaction for you. So what is the difference between a transfer and a rollover? And this is a critical piece to this. So the difference between a transfer and a rollover, when you're establishing your self-directed IRA with Equity Trust Company, some may just be making a contribution, but some may be transferring money from an existing IRA or rolling over from a previous 401k or other qualified plan. The difference between a transfer and rollover, transfers are from IRAs. So if you have an IRA with another financial institution, you're filling out an account application in an account transfer form through Equity Trust. You send us the documents. We send the transfer request to your current IRA company. They send the money back by check or wire transfer. So we're doing a lot of the heavy lifting for you. With a rollover from like a thrift savings plan or 401k or 403b, you open the account first, and then you initiate a direct rollover to the Equity Trust IRA. So you're actually calling your administrator, and you're saying, I want to do a direct rollover to the Equity Trust IRA, and then you process that accordingly. Always important that as you go through this process, you check with your CPA just to make sure you're doing things properly. Equity Trust Company can provide the documentation and how to walk you through that process. So if I have a current employer 401k, 403b thrift savings plan, or 457, can I roll it over to an IRA while still working? I know that's probably a question that's burning on a lot of your minds right now, is I have this current 401k or 403b or thrift savings plan or 457, I'm still working, can I roll it over? If you're under 59 and a half and you're still working for the company, you most likely cannot roll it over to an IRA. They're going to require that you either retire, you leave that employment, or you have had to attain the age of 59 and a half before you can roll the money over. Now, 59 and a half, that's an important age. That's the qualified retirement age in the United States, 59 and a half. Most 401ks and other qualified plans, and I said most, not all, but most, once you turn 59 and a half or older, even while you're still working, you can roll the money over to an IRA. They call it an in-service withdrawal or in-service rollover. So if you're not sure, call your plan provider and ask them if you could do an in-service withdrawal or in-service rollover. Additionally, if you had 401k money, 403b money, or other monies, and you rolled it over from a previous company into the new company you work for, you should always be able to take that previous money and roll it over to an IRA. Unlock it, roll it over to an IRA so you could start self-directing. If you leave the company, at that point you're permitted to roll the money over into an IRA. What is earned income as it relates to an IRA? So I talked about rollovers and transfers. We haven't per se talked about contributions. So if you want to contribute to an IRA, out-of-pocket contribution, and there are limits depending on the type of account you're opening. Relatively speaking, if you have a traditional or Roth IRA and you're under the age of 50, you can contribute $5,500. When you're 50 and over, you can contribute up to $6,500. But you have to have earned income in order to contribute to an IRA. So what is earned income? Earned income essentially is W-2 or 1099 income that is qualifying as earned income, income that you're paying payroll taxes on, like Medicare, Social Security, and then also the applicable ordinary income taxes. So that's the price to pay, so to speak, to get in the game is earned income. What would not be considered earned income? So passive income from rents, royalties, interest income, that's passive income. One is not paying self-employment income taxes, Medicare, Social Security, etc. So that wouldn't be considered earned income to support a contribution to an IRA. But certainly know that if you don't have earned income, it doesn't mean you cannot self-direct. If you have existing monies in an IRA or 401k rollover and you're simply just rolling that money over to grow it organically, that's acceptable. There's a number of folks out there that don't have earned income, that have self-directed IRAs, that are growing those accounts organically. They're just not making annual contributions to the plan. What are equity trust fees? So the fees at Equity Trust Company are dependent on the portfolio value of the IRA. We do have a sliding tiered fee schedule. It includes the technology stack, the My Equity capabilities. It includes all checks being written from the account. It includes all direct deposits. So you don't have to pay extra for every deposit, every check you send, every ACH deposit you send out to a contractor. We want to keep those expenses at a minimum for you. To put it into perspective for you, accounts under, at the time of this recording, accounts under $15,000 in value, the annual maintenance fee is $205. From $15,000 to $25,000, the annual maintenance fee is $290. From $25,000 to $50,000, it's $330. From $50,000 to $100,000, it's $400. From $100,000 to $200,000, it's $480. And then it continues to progress as the portfolio value increases. What I'd encourage you to do, you can email us at webinars@trustetc.com, as you see there in the right-hand corner, or you could always call us as well, 888-382-4727. We have nearly 400 employees nationwide. That phone number is going to go directly to our department that handles facilitating opening accounts and walking clients through, or prospective clients through, the process of opening accounts and helping fill out the paperwork and going through that entire process. They're not serving as your financial advisor, your CPA, but they could certainly, provide some guidance and share some more information with you as needed. So what are the steps to take action in opening an account at Equity Trust? So I mentioned calling in and sending us an email. I'd encourage you to do that. It really starts with a 2-page account application. If you're going to set up a HSA or CISA or solo 401k. There might be some additional documents involved, but relatively speaking, for an IRA, it's a simple 2-page account application. Financial application you're filling out, you're sending it back, we're getting an account number generated for you, and then we can go through the steps of funding your account via rollover or transfer, or if you're just making a contribution, we can facilitate that process as well. While I'm on this topic, I would encourage those that know this makes sense for you, you want to take action, I'd encourage you to start that process well in advance. What we find is the most common reason for folks missing out on opportunities is because they don't have their account open and funded in advance. And if you're going to transfer rollover money from an existing IRA company or 401k provider, it could take 2, 3, upwards of 4 weeks, even more, before that money comes over. We're at the mercy of that other financial institution. So very, very important that you have the account set up and funded well in advance before you start going out and finding opportunities and taking advantage of different investments. And all while you're waiting for the next opportunity, we do have a mutual fund trading platform, and there's also ETC brokerage where you could set up a brokerage account within your IRA, and you could self-direct into stocks and mutual funds, and you could do all of those trades online. Non-advisory, non-discretionary, so we're not showing you where to buy or how to buy. We don't have brokers that will call you, or you can't call them and they can facilitate, Q&A on where to buy and how to buy. But you can do that on your own. You can self-direct. You find a good mutual fund or stock you want to take advantage of, and you could self-direct into those opportunities. So that being said, I'm going to go ahead and tie everything up and wrap everything up. Thank you so much for joining us. I do have a special gift for all of our attendees, and that is our self-directed IRAs, Building Retirement Wealth Through Alternative Investing. This was written by Richard Desich Sr. It came out a few years back. It's on Amazon. It sells on Amazon if you wanted to go there, but we have a free copy of this, electronic copy of this for all of our webinar attendees this evening. This is our gift to you for attending this session. I encourage you to take advantage of this electronic book. There's a lot of great details and information, case studies, directories. The case studies, I find to be most valuable for me personally, actually learning about how other clients are using their self-directed IRAs. So I'd encourage you to take advantage of this opportunity, learning from others. I had an opportunity to write the foreword to the book, and it was a privilege to be able to participate in that opportunity alongside Mr. Richard Desich Sr., who is our company founder and started the company way back in 1974. You can email us at webinars@trustetc.com, or you could also call 888-382-4727, and we can facilitate a conversation. But for the electronic book, I'd encourage you to just email us at webinars@trustetc.com, and write in the subject line free book. Again, that's free book in the subject line, and we will get that out to you promptly. Also, feel free to write your questions to webinars@trustetc.com. We always welcome feedback, information, questions you have for us to entertain. Again, email us at webinars@trustetc.com. What a great, unique honor and privilege to be able to host another Equity Trust webinar. I'm very passionate about the business, passionate about helping investors learn more about self-directed IRAs through our non-advisory education, and I look forward to seeing everyone on our next webinar. Thank you so much. Have a wonderful night.